Did you know that the biggest difference between people who just talk about investing and people who actually build wealth comes down to a first step that looks tiny? Today, I'm going to show you how to take that step without fear, how to avoid common mistakes, and how to create a system that takes you straight to real results. Welcome to Bank It Up. The importance of taking the first step. The best time to start was yesterday, but the second best time is today. A lot of people freeze up, waiting for the perfect day, the perfect amount of money, or the perfect knowledge. But the truth is, what's holding you back isn't that you know nothing. It's that you want to start perfectly. Here's the key. Don't compete to make the best investment on the planet. Compete to build the discipline that's going to change your life. Here's a simple example. Anna and Luis both want to invest. Anna starts with $50 a month in an index fund. Luis says, "No, I'll wait until I understand everything." 1 year later, Anna already has a habit, a plan even, a new financial language. Luis, still researching, still dreaming. Who do you think is closer to the goal? So take note, your start date is today. Your symbolic amount can be small. $10 a week if you want, and your first instrument doesn't have to be complicated. A simple index fund or ETF is enough to get started. You don't need to start perfectly. You just need to start, period. Start with the basics. When you enter the world of investing, the amount of information can overwhelm you. Videos, courses, experts saying opposite things. And that makes many people stay at zero. The key is to start with the basics. Learn what a stock is, a tiny piece of a company. Learn what a bond is, basically a loan you make to a government or company. And understand index funds or ETFs, baskets that mix many assets and allow you to diversify easily. If you master those three concepts, you're already ahead of most people. You don't need to be a Wall Street analyst. What you need is clarity. And here's a tip. If you don't want to spend all day analyzing companies, start with a global index fund. It's cheap, diversified, and easy to manage. Your task is simple. Write down on a sheet of paper, what do I want my money to do? Do I want it to grow long-term? Do I want to protect it from inflation? Or do I want it to give me cash flow? That answer defines your path. Diversification and risk management. Now, here comes one of the golden rules. Don't put all your eggs in one basket. Diversification is your best shield against risk. Think of your portfolio as a pizza. The whole pizza were just one ingredient, and that ingredient goes bad, you lose everything. But if you have different slices, there will always be something to balance it out. The same goes for your investments. Mix stocks, bonds, and some cash. That protects you from shocks and makes your portfolio more stable. Quick example. Conservative portfolio. 30% stocks, 60% bonds, 10% cash. Moderate, 60% stocks, 30% bonds, 10% cash. Aggressive, 80% stocks, 20% bonds, cash, C. It's not rocket science. The idea is to have a safe core and a few satellites to try new strategies without risking everything. Patience is key. I'll be honest with you. Investing isn't a casino, and it's not about getting rich overnight. Real wealth is built with something as simple as time and patience. Here's an example. If you contribute $100 a month at 8% annually, in 10 years, you won't just have the $12,000 you put in. You'll end up with more than $18,000. Where did that extra come from? Compound interest. Now imagine this. Someone starts investing at 25, puts in $200 a month for 10 years, and then stops contributing. They just let the money grow. By age 65, they have over $400,000. Another person starts 10 years later at 35, and even though they invest $200 a month for 30 years, they end up with less. That's the power of starting early. Patience not only multiplies your money, it also gives you calm during market downturns. Because, trust me, the market drops, and it always will. But those who have patience don't panic. They wait and keep growing. The long-term investor mindset. One of the biggest secrets to being a successful investor isn't in the technique or the financial product. It's in the mindset. Money grows, but your character has to grow too. Most people quit because they want fast results, and when they don't see them, they give up. But those who understand that investing is like planting a tree know how to wait. Every contribution you make is like a seed. At first, you don't see anything, but under the ground, something is already happening. And suddenly, one day, you've got shade, fruit, and strong roots. That's exactly what happens with your portfolio. So beyond numbers and strategies, work on your patience, your vision, and your discipline. Investing is a game of years, not days. And once you build that mindset, no bear market will be able to knock you down. Learn from your mistakes. No investor has a perfect path. We all make mistakes, impulsive buys, rushed sales, following fads. But here's the trick. Every mistake is a lesson that makes you better. That's why you should keep a log. Right? Down what you bought, why you bought it, what you expect, and over what time frame. And when something goes wrong, review it. Was it bad market luck or a bad decision? That reflection is gold. The worst mistake is thinking you can't make mistakes. The investor who learns quickly from setbacks is the one who grows the most. Systems and habits that make you unstoppable. A successful investor doesn't depend on motivation. They depend on systems. Automate your contributions so they don't depend on whether you feel like it or not. Check your portfolio once a week. Not every hour. Rebalance once or twice a year to return to your original percentages and track your own KPIs, how much you're saving, how much you've invested this year, how much you're paying in fees. Those numbers tell you if you're on the right track. Remember, discipline beats motivation. If the system works, your emotions won't sabotage your money. 7-day plan to start right now. If you want immediate action, here's a 7-day plan. Day 1. Write one short term, one medium term, and one long-term goal. Day 2. Research 2 or 3 reliable brokers or platforms. Day 3. Open your account. Day 4. Define how much you're going to invest each month. Day 5. Choose a simple ETF or index fund. Day 6. Create your own policy. When will you rebalance? What's the maximum you'll put into one asset? Day 7. Make your first contribution. That day, you can already call yourself an investor. You don't have to wait years to feel part of the game. In 1 week, you'll already be in. Common objections? I know what you're thinking. I don't have much money. Doesn't matter. Start small. What matters is the habit. What if the market drops? It will, many times. What matters is that you keep investing and take advantage of the lower prices. I don't know how to choose. No problem. Start with a diversified index fund. I'm afraid of messing up. We all mess up. What matters is that your system protects and teaches you mistakes to avoid and watch out. There are things you should never do. Don't go into debt to invest. Don't switch strategies every week. Don't ignore fees or taxes. Don't put everything in one stock or passing trend and never invest money you'll need soon. Remember, being a successful investor isn't about finding the perfect asset, but about starting, learning, diversifying, and being patient. If this video helped you, hit like, subscribe, and turn on the bell so you don't miss the next tips. And share it with someone who always says they're going to invest, but still hasn't started. Because at the end of the day, investing isn't just about money. It's about freedom, choices, and building a life where you're in control. Every dollar you invest is a step toward that version of you who doesn't just dream, but actually makes it happen. See you in the next Bank It Up video.